look at the Q1 market outlook. The primary thesis which has driven the bull market over the past 4 and 3/4 years has been easy money from the Fed. Our outlook, short-term, intermediate, and long-term, remains bullish. Let's take a look here at the market. Some people say, QE doesn't really isn't a focus or isn't a driver of the S&P or the big rally we've seen, and I just beg to differ. Let's look at the facts. The S&P, the March '09 low was right around here, and then what happened was it shot up 45% once QE1 was announced. QE1 ended, the S&P fell 17% in a matter of weeks, and then you had the big speech in the summer of 2010 from Bernanke and Jackson Hole, and that announced QE2. The market shot right back up 36%, and then QE2 ended, it fell 22%. You had Operation Twist come out, some more creativity from the Fed, and guess what? The market jumped 37%. You had a little bit of a pullback before QE3 was announced, and then all of a sudden QE3 comes out right around here in November of 12, and it wasn't really as effective. 2 months later, the Fed doubles up, and they do QE3, which is what we saw up until last month, which was the $85 billion a month in asset purchases, or $5 billion more or less a day. And even with the taper, we're now at $75 billion a month, or just under $4 billion a day in new money. So that's a tremendous driver of the past rally, the 31% rally we've seen over the last 12 months or so. So there's a direct correlation between QE and how the market reacts. Not just the Fed, but other central banks around the world are also printing billions of dollars every day to stimulate the economy. The long-term outlook, we believe, is bullish. We had a new super cycle that began in April of 2013, which was last year. What is a super cycle? Well, let's just take a look. This is a chart of the S&P 500 going back to 1965, and as you can, each one of these bars is a year. It's an annual chart. So you had this massive rally at the end of the 90s. You had the March 2000 top, and then you had more or less a 13-year consolidation, where the S&P didn't go anywhere, and not just the S&P, but the other major averages as well, for 13 years. And if you look back and study history, which we showed you in the webinar last quarter, this is normal. It's actually very healthy to see these long sideways, decade-plus consolidations before a new supercycle is born. And every other prior massive 13, 15, 18-year consolidation was followed by a massive supercycle or massive new bull market. Well, over the last 13 years, we had a lot going on. You had the dot-com bubble, the March 2000 high, then you had the dot-com crash, 9/11 was in here, and then you had the housing and credit bubble. That led to the '08 crisis, the financial crisis, and we all know what happened there. There was the March '09 bottom, and then QE-induced rally. And what happened in April of last year was that we broke out to new all-time highs in the S&P and Dow and Russell and a few other indices as well. Right now, we're right up here, sitting near new record highs. So the long-term picture remains very, very bullish. And as far as we're concerned, that 1576 level, which was the 2007 high, October 2007 high, should now become support. So if we do pull back in the market, and this is just extremely long-term, we'd like to see this line hold and definitively hold. Also, this is the upward trend line since that March '09 low, and that comes into play as well. So as long as we're above that 1576 level, longer term, our outlook remains bullish. What is the intermediate term saying? Well, that's also bullish. Right now, if you take a look at the last 12 or 15 months or so, this is a daily chart of the S&P, and it goes back to February of last year. Every pullback has been shallow in size and scope. So what does that mean? The percent decline is the size, and scope lasts a matter of days or weeks maximum, not months. So when you see shallow pullbacks within a broader uptrend, that's very, very healthy. And actually, the mindset should shift to buying those dips. It's very, very difficult from a pure technical standpoint, especially from even the fundamentals, where it's the Fed induced, there's a lot of drama, there's this, there's that, there's a million and one excuses of why you don't want to stop up and buy when the market is at any of these lows. But really, if you just look at it, if you're still in that broader context of a strong uptrend, you want to do that and step up and buy weakness. Because it allows you to get a better entry point, which we'll talk about in the next section for the advanced entries, but also it reduces your risk. If you buy strength, even in leading stocks, when they break out to new highs, like the classic buy points, it's very difficult to really quantify the risk. Now here's a weekly chart of the S&P from the March '09 bottom. So this is about 5 years long. And if you ever want to look at what a bull market looks like, this is exactly what it does. This is a picture-perfect illustration of what a bull market is. I mean, every pullback at Shellowscope, even the ones that were down double digits, the 17% or the 22% after the QE1 and 2 ended, again, are a blip on a radar in the broader scheme of things. When you look at the picture from March of '09 all the way up until where we are just recently. Here's a chart of the Dow. And as you can see, it's almost a mirror image. So it's not just the S&P that's working, it's across the board. Let's take a look at the NASDAQ, and it's almost the same exact thing. The Russell has been the strongest index. Actually, it's up over 240% since that March '09 low. And what happens early on in the cycles, and now we're getting towards the latter half of the cycle, but you see these small and mid-cap stocks really roar higher, and the appreciation, they also fall farther, during the bear markets, but in the early phases of a bull market, '09, for example, 10, 11, you see a big appreciation in these small cap stocks because there's a lot of money in that idea of a recovery. They stand to benefit the most, plus they're more speculative in nature. Now the short-term outlook, what is it? Where are we right now? Well, here's a chart that we pulled a few days ago, and it was updated today. The white line is a 50-day moving average. It's a daily chart of the S&P, and this goes back about 6 months or so. And this is a closer look at what we've seen. And as you can see, the action's very, very healthy. Each one of those rectangle boxes or flat bases, however you want to word them, more or less, it's a base on base. Not perfectly, but more or less. Monday's sell-off, which was just this big red down day right here, corresponded almost perfectly to the old chart highs from back here. And that's exactly what you want to see, where this whole box or this whole area was resistance, and which we'll talk about in a second too, the concept of support and resistance. But now it's very bullish to see it become support. So as the market rallies, you really want to see, and one of the characteristics of a very healthy rally is when you see prior chart highs, which are here, here, and here, become support, which happened right now, and then 2 days later, we're almost breaking out of this box. Actually, earlier today we did before closing back in it. So as long as this healthy action continues, it'd be foolish to argue with the tape. Now, we've had a lot of drama with respect to distribution days. Well, what's a distribution day? It's heavy volume selling, or heavier volume than the prior day. And more distribution days in a cluster of them in a small amount of time isn't healthy for the market, especially after a big move, which is what we've seen. But that's secondary. Anything that has anything to do with any subject outside of price, in my opinion, is secondary. It's noise. The only thing that matters when you study the market is the price. Because the bottom line for each of us, I don't care how big you are, how small you are, how long you've been doing this or anything, it's you make money or you lose money based on one factor, the difference between your entry point and your exit point. And that's a good segue for the next section, which will talk about the advanced entry points and exits. But the difference between the entry and exit is its price. Now, you can make a million different reasons about how to study this and all those other factors, and they're all important. And I'm not discounting any of them, but they're secondary. And that's an important point to keep in mind as well. The other part to keep in mind also, the only place in this chart that you can make money right now is this area right here, that blank spot. Because whatever happened, unless if you were invested and you were long during this whole entire rally, if you look at a chart right now, it's where it's going is what matters. Unfortunately, no one can see it. So you study the history, and that's very important to study history because it's good precedent and behaviors repeat themselves over and over and over again, and history is just littered with a million examples. But understand going forward, whatever happened yesterday or before doesn't matter because we're looking forward, not backwards. So in a bull market, well, one of the advanced entry points that we like to talk about is that you want to get in there and buy weakness, not just strength. What does that mean? Now, are you going to pick up and be able to pinpoint every single time like Babe Ruth called his shots when you step up and buy these pullbacks? Absolutely not. I mean, I don't care who you are. There's no one that's able to call every single top or every single bottom perfectly every single time. It's just foolish. Our goal isn't to do that. Our goal is to capture the bulk of the move. So how do you do that? We'll get to that in the second half of the webinar with the advanced entry points. And there's many, many different tactics you can use. But the concept that I want to really bring home and then drive home towards the end of the webinar is for you to step up and buy weakness, not just strength. We're taught, most people, especially from the audience that we have here, you want to buy strength and only buy with new highs and 10 cents and this, that, and the other thing, which is all fine and dandy, and there's nothing wrong with any of that stuff, and those are classic buy points, and that could work great for many people. But there's what I've found through my studies and through actually doing this for years and over a decade or so, has been to be able to step up and get in ahead of everybody else, and more importantly, define your risk, because that's how the big institutions think. The big institutions look at any position they put on from a risk standpoint. Most individuals, or the smaller institutions, or people with less experience, I don't mean how long you're doing it by experience, I'm talking about success, because I could be playing basketball for 50 years or 40 years and I could still not be able to sink a basic free throw. So there's a difference between length of time you're doing something and actual quality, the quality of that experience. But the big institutions, successful investors in general, even small guys that are successful, understand that it's a probability and to think in terms of risk.